Hello and welcome to today's NinjaTrader Ecosystem webinar event with Lee of Emoji Trading. My name is Thomas and I'm a platform representative here at NinjaTrader. I would like to state that it is important to understand that there's substantial risk in trading commodity futures contracts. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at the link provided for more information or for a copy of the CFTC forward disclosure. Also, please remember that these training webinars are not solicitation or recommendation, but simply educational in nature. Now, this webinar is presented by NinjaTrader LLC, which is a technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the brokerage team. Now, the NinjaTrader ecosystem is home to hundreds of third-party apps and services, all centered around the NinjaTrader platform, with new tools added nearly every day. NinjaTrader ecosystem is home to hundreds of apps and services. You could quickly and easily find the tools and services you're looking for with a simple keyword search. You can also find information about upcoming webinars and an on-demand video archive to view event recordings. For up-to-date information, be sure to like or follow the NinjaTrader ecosystem on social media. And NinjaTrader is always free for advanced charting, strategy backtesting, and trade simulation. And if you were just getting started with the NinjaTrader platform, we do offer free live trading events on a daily basis. And we are very excited for this unique event in which Lee will discuss how professional traders apply statistics, market structure, and order flow pattern recognition to approach the E-mini equity futures markets every day. Thank you again for joining today. And without further ado, it's my pleasure to welcome to the NinjaTrader webinar room, Lee. Please take it away, Lee.
Thomas, thank you very much. Thank you for that introduction and welcome everybody. I'm just going to set up and share my screen. So Thomas, thank you for the invitation to come and speak with your client base. It's been about a year since we last spoke with the vendor ecosystem at NinjaTrader, so it's nice to be back. And what I'm going to do today is I'm going to do sort of a quick journey through the mindset of professional traders or prop traders. I spent some time in a prop trading outfit, and how we go about applying statistics and probability to the process of trading. And to do that, we need to consider the structure of the market, and we can then also look inside the structure of the market using order flow, traded volume, to gain an edge. And that's why I'm calling it stacking the deck. I come to this very much like playing blackjack professionally. Blackjack is very much a game of probability because you know that there is a shoe of cards in front of you, you know the makeup of that shoe of cards, you know the probability of what is playing out. That's why card counting works. And I took this approach to my trading a good number of years ago. I learned card count in blackjack. I used to go to Vegas a lot for conventions, and I thought, I don't want to pay for drinks anymore. So if I can understand the probabilities, and the way it works in blackjack is if you count cards in the right way, you get about a 0.5% edge. So you don't get rich, but your cash flow doesn't alter that much, and you get free drinks, or you get comp points from the casino. So I thought, if I'm here on business, I'm not going to pay for a drink. I'm going to spend time at the tables, count cards, get free drinks, meet weird and wonderful people to pass my time. And a good number of years ago, when I was going through a rough patch in my trading, I thought, well, how can I apply the same principles to my trading? Because I know how to sit at a blackjack table and have the odds slightly in my favor. Surely trading's the same. And this is the mindset behind all professional traders. What I'll be doing through this session, feel free to put questions in the chat box. I'm not going to look at that till the end, out of courtesy to everybody else who's attending the webinar. So I'm not going to deviate from the flow, but at the end, I'll certainly go through questions, and hopefully, you know, my presentation will have preempted any of those questions. One of the questions that always comes up is this being recorded? Yes, it's being recorded. And NinjaTrader will post a recording on their website a few days after this event. But yes, it's being recorded. Now, before we get into this, I'm just going to quickly go through similar sort of risk disclosures, which we need to do to stay clean. That's done. Thomas spoke to that up front. So what's emoji trading and what we do? Oh, we are a developer and a vendor of tools that visualize patterns within the order flow. And I'll show you what that means a little bit later on. I explicitly do not describe this stuff as indicators. Indicators is a term that really comes from technical analysis and mathematical formulas like RSIs and moving averages and MACD, moving average, crossover, divergence, all this stuff. Order flow is about tracking the volume that has traded, and we can visualize patterns that are significant within that volume. So these are tools that help you see things. They don't tell you what to do. If a given pattern doesn't mean go long or go short. It just tells you what is going on. Is there supply? Is there demand? Yeah, and that's a different mindset to indicators. But what was interesting, it's interesting that Thomas put that poll up at the beginning, and it showed that of the attendees, 40% have looked at indicators through the vendor ecosystem at NinjaTrader, 20%, so half, have looked at education. And something I firmly advocate, and I say this to all of our prospective clients at Emoji Trading, is before you do anything relating to putting tools on your trading platform, understand from first principles what it is that the tools are doing. And if we're talking about traded volume, what this means is actually being able to read the traded volume from the raw data, we'll get to that and what that looks like, and be able to recognize these patterns on your own, just from numbers. Because until you can read this stuff from first principles, applying a tool or an indicator and hoping it to work like magic and you're going to make your fortune trading is it's a foolish path to take. I suggest you're not going to buy some powerful chainsaw or circular saws, cut a bit of wood, unless you've got a rough idea of what cutting a piece of wood means or how to use a manual handsaw. Yeah, you're going to cut your thumb off or lose a limb. Trading's no different, but for whatever reason, people think they can come to trading, apply a bunch of technical analysis, wiggly, wavy lines to a chart, and magically get rich. And trading is a learned skill. It is really hard, but a lot of what is hard is overcoming the dumb organic matter in our brains that makes us believe we're infallible and we're smarter than everybody else. And the industry does this. I mean, the industry has to attract people in the hope that they're going to do really well trading. It has to make it appear as simple as possible. And the fact is it's not simple. So I firmly advocate you must learn from first principles. You've got to understand what the stuff on the screen means, why it's doing what it's doing. Once you have got that understanding, then you can properly evaluate add-on tools, add-ons, indicators, whatever else, fully understand what they're doing and qualify whether the vendor is talking nonsense or actually has something sensible to offer, and use these as productivity tools to make your life easier and potentially gain an edge. So we formed an educational group a couple of years ago now called Trading Research Group, which is platform agnostic. We don't rely on indicators in any way, shape or form. And what we do is help people to learn how to read the order flow from the raw data. And with that knowledge, what we research and we create various trade setups based on market structure, and we help people apply their understanding of the raw information and the market structure into actionable trade setups that you can use every day. And some of these trade setups are based on things like the range of the first hour. I'll give some examples a little bit later on. Other setups relate to price action and scalping, and how with very simple, fast charts, like 15-second charts and a simple understanding and application of price ranges and volume, you can scalp. And this leaves you in a position where you can trade the equity futures really at any time of the day under pretty much most market conditions, whether your objective is to dive in and out in a matter of seconds and grab 2 ticks, 3 ticks, 4 ticks, which if you do it with 10 lots is very nice, or look at events that play out with statistical probabilities at certain times of the day and grab multi-point moves. We had a live trading session earlier today in Trading Research Group where I traded the break for the first hour, I traded it short, and I think I was trading 2 micros and it ended up being something like $1,000 trade. 1,000, what am I talking about? I'm thinking minis. It was a $100 trade trading 2 micros. Yeah, I traded micros because I was doing a live session. My brain wasn't in the same place it would be if I was trading my own personal account. But we can get these kind of multi-point moves every day, or you can just pull up your charts and you can scalp price action. So this is a bit different to where a lot of people come from. A lot of people are drawn into technical analysis, and we'll have a chart that looks something like this. This is NinjaTrader. I've got candlesticks up there. What is this? Oh, it's a 5-minute chart. Very good. All chart periods are wrong. The market doesn't know that we're looking at 5-minute charts. It doesn't care that we're looking at 5 minutes. So this slicing of the movement of price into 5-minute intervals from left to right, totally arbitrary, therefore it's wrong. We've got some bands, look like Bollinger Bands to me. Very clever guy, John Bollinger, had some great concepts. I studied Bollinger Bands for a long time in the 90s. Really good if you trade options because of the tracking of volatility. But so many retail traders trade bands in the wrong way. I see we've got some pivot points. We've got R1 and R2 on the right. They must be important because they're appearing on the chart. What do they mean? Resistance. Oh, we've plowed through it. Interesting. And then we've got some, MACD at the bottom. This is how most people look at the market. And people I've trained in the past, who I've taught order flow, who've come from this sort of background. I've asked them initially, tell me about how you go about your trading day. And they say, I pull up my chart, which looks something like this, and I wait for patterns, or I wait for X to cross Y, or this to happen on the lower band or the upper band, and then I take a trade. And that's the extent of their planning. Maybe they look at a longer time frame chart first, or they wait for confluence on multiple time frames. This was fine many years ago. Metastock era, 80s, 90s, when computers could get price information in real time, and you could apply mathematical formulas to create these wavy lines. But everything on this chart is derived from price. And here is the inherent problem. Price does not move because of these wavy lines. These wavy lines are an output function of calculations based on price. The only reason that price moves is because of volume being traded. So in the futures market, where we've got a centralized exchange, if there are more aggressive buyers, market orders, who are lifting the offer, so eating up all the resting sell limit orders in the book, then as that liquidity is consumed, price goes up. So price moves because of the volume that's traded. So if you are looking at any representation of the market, which is what this is, it's a representation sliced arbitrarily into 5-minute slices, and you're not taking any account of volume into your analysis, then you are trading at a serious disadvantage. And that is why the majority of people who use these sorts of methods, technical analysis, don't do that well. Because if you do not take volume into account, you are missing the driving force behind what's happening. The other thing that retail traders tend to do really poorly is how they trade levels and patterns and support and resistance, which are frankly quite nonsense terms. Yeah, arbitrary lines that we draw across patterns on a chart. So here we've got some kind of bottom pattern, head and shoulders, bottom, cup and handle. Doesn't it sound ridiculous as I say these phrases? Yeah, head and shoulders, cup and handle. Yeah, and the way that most retail traders who've studied chartism, technical analysis, John Murphy, technical analysis, the futures market, will look at something like this. I think, oh, there's all this resistance above me. Oh, it's a trend line. I could trade a breakout of the trend line. And depending upon how they look at this trend line, they might front run it. Let's enter ahead of the trend line, ahead of the break. Or let's wait for it to break and I'll enter long. Or I'll enter on a pullback. And they put their stops in really obvious places, and the stop gets hit as it goes backwards and forwards and ebbs and flows. And oh, they got my stop. No, you didn't trade this in a smart way because you don't understand what's going on under the covers. There is no they. Yeah, we can't blame they for our mistakes. There's a bit of they in the Forex market. That's a different issue. That's why we trade futures. The other problem with drawing lines like this is this whole idea of pitchfork, brilliant. This whole idea of support and resistance and trend lines. And the more times this level is touched, the stronger it becomes. Okay, well, if I turn this 5-minute chart, actually it's a 1-minute chart. If I turn this 1-minute chart into a 5-minute chart, it's going to be touched fewer times. So what, this is stronger on 1 minute. If I turn this into 15 seconds, there'll be more touches of these various areas. Now, we can't actually draw this line. The line doesn't exist at this first point. At this second point, okay, we can connect two levels, but it's only at the third point where it becomes anything. Yeah, we have a clue from here to here. We can extend this out to here. Maybe we act on it here as a TA chartist trader, or maybe we act on it here. And that's when it broke out. But hang on, I thought you told me the more times a level is tested, the stronger it becomes. Well, it seems to be the opposite, doesn't it? It seems that the more times the level was tested, the weaker it became. So who's right? What I read in all these books on the broker websites, or what happens in actuality? So the reason this kind of thing happens is because supply, selling, yeah, not resistance, supply, selling, and demand, buying, is not infinite. There is not infinite supply and demand. Sure, there are trading organizations that have near as damn it infinite volume. Yeah, American Airlines' ability to trade CL is much more than yours or mine. Fidelity Investments can do much more in the equity futures market than you or I can. So they have deep pockets, and if they choose to express a trading idea or a position, they can throw volume at it. But ultimately, for whoever decides that this is an interesting area to sell, at the point they're done selling, there's no more supply, which is why the levels break. So this whole idea of trend lines and support and resistance, as is explained in classic technical analysis approaches, is wrong. It doesn't work. The more times the level is touched, the stronger it becomes. Well, is it 2 or 3 or 4? It doesn't exist to where 3 anyway, and the 4th time it broke, so that's no good. So as a professional trader, how do you go about trading this kind of pattern? Well, you do it like this. Yeah. What we're interested in doing is, first of all, we can see by looking inside this candlestick, by looking at the volume, looking at the supply and demand, what clues are there, that there might be an event that actually kicked off some supply. Even just looking at this chart, how do we know there was an event that kicked off some supply? Big red down candle. Probably happened on high volume as well. Something happened in here to imply supply. Same thing happened again here. If we look at the volume that traded, we'd actually see it. We'll get to how you can start to visualize the volume that traded. So what's interesting is if we know that there is supply, then we don't want to trade when that supply stops. Surely it's smarter to see, are there any clues that show us where this push down is too low? Are there any signs of demand? Can we join the demand and get out ahead of or at where there's supply? And then we see what happens when we get back there. But rather than this whole idea of let's trade the breakout at the point of the breakout, no, we know that there's something going on from the moment we see supply in the market. So we can use this as a known point in the market that might be a good place to get out of a trade towards it. Different way of thinking about breakouts. When you start thinking about supply and demand and levels in this kind of way, and you forget support and resistance and all these TA terms, what you end up realizing is that ultimately there are only 2 types of trade. The market moves somewhere, and then it consolidates, or as we would prefer to say, it ebbs and flows, creating a range, and then it might break the range, and it might move, and it might consolidate, and then it moves again. So when you identify a trading range, there are only 2 ways to trade a range. We can be inside the range, trading to the edge of the range. So for simple terms, let's call this inside out. Or we can be at the edge of the range, trading back into the range, outside in. Oh, reversion to average, reversion to VWAP. No, that's also nonsense. We have ranges, and we're either trading from the middle of a range to the edge, inside out, or from the outside of a range back in. And this is when market structure gets really interesting. So if I think about ES, E-mini equity futures, the S&P 500, there is this concept which comes from market profile of the range forms during the first hours trading during regular trading hours. So that's the price range between 8:30 and 9:30 Central every day. And that's known as the initial balance. But let's just call it the first hours range on ES. Well, NYSE cash markets open, 8:30 to 9:30. Now, when you run the statistics, and I've run them, and I keep looking at them, very roughly, yeah, and don't trust me, I'm some random guy on the internet, pull up your chart, go back through 10 days, 20 days of ES, and count up how many days the first hour's range is broken during the trading day. And what you will find is that ES breaks the range of the first hour pretty much every day. A couple of weeks ago, actually, we had 2 consecutive days where it didn't. That's really rare. The rough stats, whether you look at month, 3 months, year, 2 years, doesn't really matter. But about 98% of all trading days will break the first hour's range. So that tells us every day on ES, after the first hour has passed, we can look where we are and trade from somewhere in the middle to the edge of the range, maybe even beyond it. That's getting a big read. Let's just stick with from the inside to the edge of the range. So 2% of days, it doesn't happen. So that also tells you if about 4 days a year, this first hour's range doesn't break, then it's pretty daft after the first hour to fade the edges of the first hour's range, because 98% of the time it breaks. So you might fade it for a tick or two, it could be scalping, but something else you hear is professionals always fade the edges. Well, actually, no, we don't. Yep. Edges will break many, many times until they stop breaking. But in order to understand when is this edge solid, when is it not going to break, you've got to look deeper inside and look at the volume. A candlestick doesn't tell you. So we know that ES every day after the first hour is going to trade from the middle to the edge of the range. Now, after it's broken this first hour's range, on about 35% of days, let's call this 2 days out of 5 in a given week, roughly, it will go from this break all the way back to the other side, which is a really potentially huge trade. It can be 10, 20 points. So all we need to do is every day take a view as to which side's going to break, and then after it's broken, decide, is it one of the 2 days out of 5 where we might turn around and go all the way back to the other side? So now we've got 2 types of opportunity in our playbook that's based on statistics. And it makes our trading job really simple. Our job at 9:30 Central is to consider the range. We're somewhere in the middle. Let's flip a coin. We're going to go up or down. If we bet up, we know that we're wrong if it breaks the bottom. Yeah, but we want to do a bit better than that. After it's broken, one of these sides, then let's understand the nature of the break and see if it's one of the 2 days out of 5 where we go all the way back to the other side. And the beauty of this outside in trade is it's really strongly asymmetrical. We carry low risk because we're trading from the edge of the session back into the range. And actually the statistics tell us we have good probability of getting all the way to the other side. So we might risk a handful of ticks, literally 3, 4, 5 ticks in order to gain a multi-point trade. And we know exactly when we're wrong, which is really important. Now, I see lots of people asking, where should I put my stop? And I various forums and Facebook groups, and people talk about stops in terms of points, which is madness. When I was in a prop firm, we're all, it's drilled into us, you need the best quality entries. And when you trade using order flow, which we'll get into, you're literally taking trades where you are wrong and identifiably wrong through patterns in the volume of, let's say, between 3 and 6 ticks. So that means you can trade with more size. Now you've got to be good at acknowledging that you're wrong. Yeah, if the monkey in your head, that's how we refer to it, If your psychology gets the better of you, and I can't possibly be wrong, you're going to incur big losses. But when you have got really quite clear ways of identifying, I am wrong here because you can trade with extremely low risk. I'm not saying stops, low risk. You will exit your trade manually, which means ultimately you can trade more size. If you trade more size, you don't need to swing for massive results. If you take a point and you're trading 5 lots, actually that's a decent number. And this is the mindset in professional trading. So how can we understand which direction? The tool that we use, well, it's not even the tool, the information that we need in order to assess supply and demand and make determinations on things like which direction to go in is the volume that has traded at every price. This kind of visualization is what's known as a footprint chart. This is NinjaTrader 8's lifetime license, and it's what's it's called a volumetric bar in NinjaTrader. At Emoji Trading, we have a free implementation of a footprint chart called FreePrint. I'll get into that a little bit later and let you know how you get it. But unless you are looking at the volume that has traded at every price level, you are not using all of the information that the market is giving you in order to make decisions. So by learning to read the information contained in these volume numbers, you can start to understand, is the top stronger than the bottom or the other way around? Which one's more likely to break? And people look at these charts, footprint charts, traded volume, and go, oh my God, there's so many numbers. Yeah, there are a lot, but you don't need to look at every number. You only need to look at patterns in the numbers that matter. And a lot of our education is all about how do you read meaningful patterns within these numbers? Because if you can't read these patterns, then it's pretty awkward trying to do much more. And once you can read traded volume, whether it's in this format, the footprint chart, or in a volume profile, or in a dome, you are well on the way to being able to trade like a professional trader. And what this representation is doing, this is still a chart, this is a 30-minute chart, which I've put up, but this visualization is taking all of the trades that hit the tape, the time and sales, it is organizing them into buckets of 30 minutes. So every 30 minutes, here are all the trades. Then it is showing the quantity of contracts that lifted the offer or aggressive buy market orders on the right-hand side and aggressive sell market orders on the left-hand side. And that's organized by price level. So the footprint is taking all of the trades that occurred, grouping them by time, grouping them by price level, and grouping them by side. So we are getting so much more information than just candles. Yeah. And there are patterns that live within here. Once you can read these patterns, you can start to apply these patterns to behaviors which occur in the market. So the kind of patterns which are important to allow you to take a view as to which direction the market might be moving are things like aggression. So are market orders overwhelming limit orders? There are summaries, contextual states. So we could look at overall, what's the net aggression within a given bar compared to previous bars? Have we reached a price level which demonstrates that it is not too high or not too low, and therefore likely to be revisited because there's a level beyond it which must be too high or too low if the level we reached is not too high or too low? That's a concept known as unfinished business or unfinished auctions, one of my favorites. Exhaustion, are we running out of aggressive buying or aggressive selling? Or how can we see reversals? One of my favorite patterns is a pattern I call the price projector, which shows that we're running out of aggressive trading in a given direction, the auction has finished, and we've got aggression coming in the other way. So there are lots of patterns that you can learn to see in the raw data. And Emoji has various pattern recognition tools. So what I have here is the Emoji price projector, which allows us to easily spot these patterns. So the red and the green blocks are instances of the price projector pattern. But if you just come to this thinking, oh, wow, that looks really good at spotting reversals, there must be this amazing indicator, this is not the way to think about it. If you put this tool on a chart and trade every, sell every red, buy every green, you're not going to make money. Yeah, because this is not a magic indicator or a trading system. This is recognizing a pattern within the traded volume that shows we have run out of aggressive trades in one direction and we have turned around the other way. But that could just be momentary. Yeah. What matters more is how you apply this in the context of the market structure. So to take this idea of the inside out trade, the first two bars here are our first hour's range. And what I can see is I have my price projector pattern at the top. So we have a good reversal pattern at the top. We're running out of aggressive buyers and aggressive selling came in. At the bottom, we've got nothing. So if you put me bang in the middle, as actually we ended up, based on the information available to me, the top seems stronger than the bottom because the top is showing signs of reversal, the bottom isn't. So what do we do? Well, close that bar, enter short, you could, but you're taking on quite a lot of risk, far more than I'd want to do. That's what, 5, 6, 7 points? Not interested. We wait, we gather more information. I'm only looking at one pattern here, but sure enough, after a while, we get the same pattern coming in, a price projector, and from this level, so imagine we entered short around here, where my pointer is, yeah? 6, 7 ticks of risk, because if this pattern disappears, I'm wrong, yeah? I'm placing a bet based upon the fact that I know ES pretty much every day is going to break one side or the other. Early on in the session, I'm getting clues from the supply and demand that the top is more secure. There is supply versus the bottom where there aren't signs of demand. So I need to find a favorable area to get in short. Here's my favorable area, similar pattern. If I can get in short around this level and exit before it breaks, sure, it might go further, but let's bank something. Yeah, now I've got a really nice asymmetrical trade. So here is how professional trades fades the edges. I'm fading the edge of this rotation because there's supply at the top of this rotation. And I'm taking on very low risk versus where I can get to. So that's how reading the order flow, and if you want to be more efficient, applying pattern recognition tools to it, can start to help you trading in the context of market structure. And this is a much more robust way of trading than having 5-minute chart, gazillion wiggly lines on it, trading every crossover or pattern or pitchfork or whatever else occurs. Or it's a fib, it's the 34.798 fib. So what? It's an arbitrary mathematical number. This is real. It's supply and demand. We can interpret it and act on it. Something else which our toolset does to help your productivity is, aside from seeing these patterns in the order flow, I like to think of them as events in the supply demand. Here's a supply event. Here's another supply event. This is how the lines that people draw on their charts start to be drawn. This is the first point in the line someone might draw. This is the second one, third one, who knows? Yeah, but we're at the start of where the TA guys are drawing things. We're seeing the supply and demand as it happens. So these are the individual events. But we have a technology we call Emoji Zones, which when we have an event, excuse me, in the supply and demand, in this case, I'm tracking aggressive trading. So heavily aggressive selling or aggressive buying. We track these levels over time, and based upon the volume that trades through these levels, we determine from the volume which trades through these levels whether the event that kicked this off is likely to hold or break. So rather than thinking the more times that the level is touched, the stronger it becomes, no, we are able to see that the demand that was triggered off back here at some point traded in such a way that it held after this red candle traded into it, but the volume that traded down here from patterns in the order flow told us it no longer would hold. Sure enough, we get back down here again, we go down. And this is something that's really hard to do as a human. And this is the value of tools. Tools are there to enable you to do things in your software which are too hard to otherwise do yourself, which is why you will never hear me refer to this stuff as indicators. Yeah, this is pattern recognition and tracking of the order flow through these areas over time. So we can identify lots of good stuff within the order flow traded volume, and we can track these things over time. Now, lots of you will be thinking, fantastic, you know, new add-in for my platform. I want it. And I will urge you, once again, do not start with tool sets until you can understand what is happening in the traded volume from the raw data, first principles. Do not spend money on any tools, even though I'm geared up to sell you stuff. Yeah, I would much rather you educate yourself. So 20% of people have looked at education in the vendor ecosystem, 40% have gone for tools and indicators. I would urge you to be in that 20% group first of all, because once you've got knowledge as to how stuff is going on, then you can qualify the value of tools and apply it to whether it makes you more productive, if you even need the tools at all. So what we do within our educational group, trading research group, is we teach this stuff from first principles. And we have a couple of beginner classes, which start this coming weekend, the 28th. We take our education in 2 chunks. We have, under this banner of order flow for beginners, we have a class starting this weekend, which is looking at the inside out and the outside in trade setups using ES, where we will teach you market structure, the statistics, and how to read order flow from the raw information. So we have a couple of lectures on Saturday and on Sunday. We have a live trading session on the 2nd, which is next Thursday, and on Friday, a wrap up and open Q&A. And after you take this course, which is a $299 course, you then get 2 weeks complimentary access to our main group. The majority of people that take this course continue in the group, surrounded by a really good number, about 150 members right now. We've trained hundreds of people on these methods. Everyone's at the same knowledge level, using the same techniques. Yeah, it's not arguing about what fib number is more relevant. Everybody is understanding and trading pretty well in the same way. A week later, we run a similar beginners class on how you can scalp using fast charts, price action, bring some simple order flow concepts. And this runs again over the weekend with a couple of add-on sessions following during the week. By combining these 2 beginner classes, you end up equipped with a tool set and able to look at the market through a lens that enables you to trade the CME equity futures in pretty much any market condition. You can look at your fast charts, even a fast footprint, and you can scalp for a few ticks at pretty much any time of day. You can also apply these concepts to other markets. Works well on CL, GC, Eurex products. You also have trade setups in your playbook, which you can use at certain times of the day because they're statistically frequent. So I'm not saying that after some quick intensive training, you're suddenly miraculously going to be an incredible, consistent, profitable trader. That's up to you. But you are equipped with the tool set that with practice and work helps you trade in that way and helps you develop. Within our trading research group, you have access to a huge number of recordings and deep dive educational clinics. We have a 24/7 online chat community, and we have a bundle for both of these training classes. The coupon code is TRG Bundle Q3, where if you sign up to both, you save $100. So you can learn both of these techniques for just under $500. If I switch to this view here, I'm going to go to the items which I've referenced. So if you would like to start to experiment with how you can visualize order flow traded volume within NinjaTrader, then visit emojitrading.com/freeprint. I'll put that in the chat. /freeprint. And this is a totally free of charge add-on for NinjaTrader that allows you to have footprint charts within your platform. And it uses the display format, i.e. teach from this 2-column display format that exposes everything that's going on under the covers within the order flow. You need NinjaTrader 8. It works on any license of NinjaTrader 8, and you must be running Windows 10. It will not work on Windows 7. But Microsoft stopped supporting Windows 7 a couple of years ago, so why should we? Our pattern recognition tool is called the Order Flow Suite, and that's available from NinjaTrader 8. I don't want you to start using this until you've had education, but I know lots of you will. So, you know, far be it from me to stop you doing what you want to do. You can play with our order flow suite. It has a 14-day free trial at the link which I've put in here. So emojitrading.com/ninjatrader/order-flow-suite. And this is pattern recognition stuff for aggression, absorption, exhaustion, lots of good stuff, lots of tracking of the supply and demand events. But once again, I urge you, don't do this. Don't do this until you can read the raw data. Yeah, be part of the 20%. And to be part of the 20%, the way to get skilled up is to join one of our beginners courses at Trading Research Group. The link is here. So this is our course schedule. Our structural trade setups class begins this coming Saturday. And then the following Saturday, our price action scalping class starts. These are live educational events. The best way to learn is live. I mean, ideally, we'd all be in the classroom, but that's not happening. I'm in the UK, most of you aren't. So we use Zoom. We have lots of interaction, lots of Q&A. All of our training is recorded. You get access to recordings within 24 hours of the lecture. And you have access to all the course material for 3 months from the date of the course, or for as long as you remain a Trading Research Group member. And we include 2 weeks of membership of Trading Research Group so that you can kick the tires on our group and see if you like being amongst like-minded people. So our first class starts this coming Saturday. A week later, we have price action scalping, and you can save $100 on the combined price of both classes by using this code TRG bundle Q3 in our checkout process at tradingresearchgroup.com. So that is really what I wanted to cover today. I'm going to skim through the questions. I've got to say, we seem to have had a much quieter and much more polite audience than the last time I presented with NinjaTrader, where someone was screaming at me, basically saying, shut up and show me your indicators. So let's just have a look at what people have said. Abe, my game plan is wishing, praying, hoping, threatening markets go my way. Yeah, not bad, but maybe not so good for the long term. One of our members, what's it? Hope is not a ticker symbol. It's why we've got to use all the information available to us, all the pertinent information available to us, to stack the deck in our favor. Yep. And until you can read the volume, then you're not doing that. Dan asked, how do I figure out the range? R1 and S1. No, R1, S1, arbitrary nonsense, Dan. Yeah. Background to pivot points. Yeah, pivot points were used by pit traders when you had a pen and pencil and a bit of mental arithmetic, and you would add yesterday's high, low, and close, divide by 3, and you have a pivot point, and then you can project by the range up and down to look at likely extensions. And if you're in a trading pit full of dozens, hundreds of other traders, and you've got a pen and pencil, it gives you a rough guide. Yeah, but it's not magical, it's arbitrary. Okay, lots of people might act on these same arbitrary things, but whether this will hold or break, you don't know unless you can read the volume. So the kinds of ranges which are important are things like the overnight high and low, the session, regular trading hours session, the first hour's trading range, the opening 5 minutes range. Yeah, these are things which are based on the market structure. Anything arbitrary, value area high, low, 3 standard deviations from VWAP, it's all arbitrary. Yeah, market structure is what's important. So really excellent question here for Andreas. What is safer, inside out or outside in? A superb question, Andreas. Safer, well, I can answer this in a few ways. Inside out on ES happens pretty much every day. It's about 4 days a year where it doesn't happen. Outside in happens 30 to 40% of all days. So if every day you're trying for an outside in trade to get all the way to the other side of the first hour's range, you're going to get run over quite a lot. You might trade into the range a bit, but trying an outside in trade every day, just based on the statistics of the behavior of ES, seems like a foolish endeavor. You have the statistics not on your side. But if you can identify the patterns in the traded volume and the order flow as to what's going on, both are safe, because we're always entering where there is demonstrable supply or demand, and we're trading in that direction. So we should always be trading with minimal risk. So once you can read the traded volume, they're both safe. Which is easier to execute? A lot depends on your personality. I love trading the inside out trade. I actually take the inside out trade on the second 30-minute period of regular trading hours, because the second 30-minute period will pretty much always break the range of the first 30-minute period. And I know by the end of the second period, it's over. It's either happened or it hasn't, and I've got it right or wrong. Yeah, that's really safe. I can't take that trade setup after the second 30-minute period is concluded. And a lot of trading is actually protecting your account equity from yourself and your greed and your bad emotions. So by having tightly defined trade setups and adhering to them, which is hard, and that's really work you have to do, that's how you stay safe. Safe's an interesting word to use there, Andreas. Now, another way of looking at this is outside in is very asymmetrical. Yeah, we're trading at the very edge of the session range, at the extreme, to go back into the middle. So if you read it right, it's pretty safe because you know when you're wrong. Yeah, if we're trading from the inside out, we're in the middle, but we're always looking for a sign of entry in the prevailing direction. So I would not say one is safe than the other. They are both very complementary. What is great is that inside out on ES happens pretty much every day. Anand has asked what instruments can be traded in this way. Any instrument that has decent liquidity and traded volume can be read really well in this way. You know, ES is a dream on this. CL is good. Nikkei on the Osaka contract, MJNK, the Eurex products, Bunds, Eurostocks, these are great. NQ is a little thinner, but you can do tricks like compress the tick size, turn it into a 50-cent rather than a 25-cent tick or even a point, and you start to see the same patterns. Yeah. So volume is volume. Now, you also ask, is there a dome for Forex pairs? Forex is horrible because currency is not traded in a centralized way. The beauty of futures is that the trading happens on single centralized exchanges. So the volume is its actual volume. Problem with equities is multiple trading venues and dark pools, these mysterious dark pools. Crack the secret of the dark pools and you make a fortune. Nonsense. Yep, the beauty of futures is centralized volume, so you get the true picture. Now, of course, there are CME currency futures. I personally don't like currency, partly because of the existence of the Forex, the spot market. So what is leading what? And let's face it, the spot market is huge. Also, because it's effectively 24-hour trading. There is less structure. You have to look at an Asian session, London session, New York session. Now, I understand a lot of people are drawn to Forex because of low cost of entry, low value per pip. If cost of entry is an issue, I'd urge you look at CME micro contracts. Yeah, micro contracts on the equities, because you are getting the true picture on volume, which is important. Sebastian, who's a name I recognize, price projector, you can train spot instantly, but the tool saves you another 1 or 2 seconds, which can be a few more ticks. Exactly, productivity tool. Don't use tools before you understand the concept. I have a fan club, which is great. Robert has asked, will I post a link to the download? Robert, I've put links in the chat for everything which is on my screen here. Robert saying my website's free indicators section has a drop down for choosing platform name list here. Yes, I'm not talking about free indicators. Follow the links which I've put exactly in the chat, and you will get to the NinjaTrader specific offerings which I'm talking about here. So the links are in the chat. So they're above your question in the chat, Robert. PJ is asked, what type of time do I use? 5 minutes, 15 minutes, range bars a tick? Another excellent question. Every time frame you look at is wrong, PJ. The market neither knows nor cares that you're looking at 5 minutes, 15 minutes, 10 range, 8 tick reversal, 4 tick Renko. It's an optical illusion. You are choosing to slice the movement of price from left to right across your screen based on some trigger, which might be time passing, it might be 10 ranges of price, it might be tick. The problem for order flow trading of using range bars or tick is, while it looks really pretty, is we lose the passage of time. Now, ultimately, the market works to a clock. Globex, CME futures, opens at 5 p.m. Central. New York cash opens at 9:30 Eastern. Big influx of volume, and the futures will do stuff relating to the cash market. So the only truth, I would contend, is the whole session. Yep, it's the trading from 9:30 Eastern, 8:30 Central, until settlement or Globex reopen. So the volume that trades at every price level over these 6.5, 7 hours, whatever it is, that's the truth of what's gone on. Then we need to look inside, but it's all arbitrary. I look at the session, I look at the volume that comes back from the edge of the session, and I also look at 30-minute footprint charts. And the reason for 30 minutes is a lot of the trade setups I use, which I educate on, are based on the concepts of market profile, which looks at 30-minute rotations. So by looking at volume in 30-minute slices, I can start to qualify the shapes and the patterns that appear in market profile. But there's very little you actually need to understand about market profile. But my main view of the market, PJ, is actually 30 minutes in the session. Or at the other extreme, if we're scalping price action, 15-second charts. A minute is too slow, which is going to blow a lot of your minds, yeah? If we need to see what's going on right now, we either use the DOM, which ultimately is what you use when you're in a prop firm, or if you just want to glance back at what have I missed since I looked away or I went to get a cup of tea, 15-second charts are going to give you a good sense of the movement, the momentum, the ebb and flow that's happened in the recent past. Anything else, a minute upwards, you don't capture the back and forth. Abe has asked, you can't attend, is it being recorded? Yeah, we record everything, Abe. The library within Trading Research Group is huge. We have got hundreds, maybe thousands of hours of videos. Our educational classes are all recorded. The recordings are made available to our students within 24 hours of the event. As a training student, you have access to the recordings for 3 months from the start date of the class, or for as long as you're a Trading Research Group member. The class this weekend, it starts at 7 o'clock Pacific on Saturday, another session 7 o'clock on Sunday. We start this early time on the West Coast, so we can cover everybody from west of the US through Europe. Typically a couple of hours for each session. Relatively intense, but we go on for as long as we need to ensure that the concepts become embedded. How much is our software after training? Our software is the same price after training as before training. Before training. So Order Flow Suite for NinjaTrader 8 is $99 a month. It begins with a 14-day free trial. But even after you've been trained, I would say don't take any software, don't take any tools until you're at a point where you can read the raw data within the traded volume. Once you can read it and you find, okay, I'm reading this quite competently, but now I want to spend less time reading it. If I've got a marker on the chart and it draws my eye to it and I know what it means, that's the point when you gain benefit from investing in tools like the Order Flow Suite. If you try and shortcut the process and go, oh, I want red and I want green, that's gonna make my way to millions, yeah, you are cheating yourself. No differently to if you go into the gym and you try and squat 405 pounds, you're going to get a really bad back injury if you haven't spent a lot of years building your strength or doing your warm-up stretches. This is a learned skill. Yeah, so learn it from first principles using good factual education, then up your game and become more productive so you can do other things using tools that augment your knowledge. That's the strongest recommendation I can give you. So I've answered all the questions, so I believe. If there are any other questions which I can help you guys with, please drop them in now. The main call to action I would urge you to do is visit our site, tradingresearchgroup.com/course-schedule. Read up what we do, watch some of our videos, read our testimonials, yeah? We have trained hundreds of people in these methods. They've all developed really well as traders. And we can get you to a point where you can read the raw data, you can trade events that happen every day in ES, and you can scalp using price action at any time of the day on the E-mini equity futures. And if you're interested in acquiring both skills, you can save $100 using this coupon code. So that's it from me. Thank you very much, everybody, for attending. I hope this was thought-provoking, entertaining, maybe even useful. And I hope to see some of you at one of our forthcoming events. So thank you very much. And I guess back to you, Thomas.
All right. Well, I would like to give a special thank you to Lee of Emoji Trading for a great presentation today. Now, NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope you will attend them on a regular basis. We would like to remind you that the information provided today was that of Emoji Trading and not of NinjaTrader. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.